Hey guys, we're going to be going through GameStop today. I'm going to be going through the price and give a little breakdown of what's been happening, and then we're going to look at one of the largest financial markets in the world where these big investment banks have not billions but trillions of dollars, and how these big investment banks have continued to screw over the little guy and I suppose AMC and GameStop as well. So before we just get into that, please give a like on the video, and if you don't, that's also fine. Right, so you can see GameStop's price is at $150.85, and if we just go to the daily chart, you can see it went from around about start of the day at 153, went up to 156, and then has been on a bit of a downward spiral, now closing off at 150. And if we just zoom out a little bit, you can see we're still above this line of support at about 140. It's now at 151, which is good. So it'd be really interesting to see where GameStop goes at the next couple of days. The RSI touched 30 and is now on the high side, increasing, but now has a bit of a downslope as well. So that's why we saw a big price increase yesterday, was because it hit that. Then a lot of swing traders, algos and things like that would have kicked off. Right, but we're not here to talk about GameStop's price. We're here to talk about the underlying troubles in the financial market that affect GameStop in terms of the MOAS. So first, I just want to say, what is a derivative? Well, a derivative is a contract between two or more parties whose value is based on an agreed underlying financial asset or set of assets. Now that can be a security or a index. Common underlying instruments includes bonds, commodities, currencies, interest rates, market indices, and stocks. So that's kind of the underlying, and now it's a contract. That's the key thing here. So we have a list of the top 25 commercial investment banks which control derivatives, and we have the banks in here, order of 1 to 25, their total assets and the total they have in derivatives. So if we just look at this straight away, you can see, for example, JP Morgan Chase has 3 trillion in total assets. This is in millions. 3 trillion in total assets, yet the derivatives are 52 trillion, much more than that. Goldman Sachs, they have 288, but then combine that, the derivatives go up to 50 billion, so that is almost leveraged at 200 to 1, which is crazy. So just before we get into that, the total derivatives is actually larger than the entire GDP of the world. So the reason for that is the differences between well, you can see how large is the derivatives market in total. It's up overestimated in $1 quadrillion, which is a number that we can't even really size. So that is 10 times more than the world GDP. So why is this? Well, we have market value, which is the price of an asset that would fetch on the marketplace, and then we have the notional value, which is the value of the underlying asset in a derivatives trade. So the example would be here: if you buy an Apple call option with a $500 strike, if you buy a Apple call option for $500 with a strike price of 150, then the underlying value of that option is 15,000. Yet the market value itself is only 500. So that kind of shows the difference in the actual value at that time, but what it can be. So there's a lot of wild speculation and gambling that's involved in these investment banks. So if we just go to yeah, you can look here. I would recommend looking at Investopedia here for differences between notional and market value. But the main kicker is that these banks are massively over leveraged compared to their total assets. This would be the equivalent of you having $100, but then only having $100 in your name, but then $2,000 in wild bets. That wouldn't be a very good recipe for success, because if your bets fail and you now owe $2,000, well, there goes your $100, and now you're in the red massively. And why is that important? Well, if we go back to a little thing which happened down in 2008, which was the housing market crash, the Treasury Department invested $200 billion in the banks. And if we look at the banks here, we can see that we have, well, number one, we have JP Morgan currently, and they were bailed out with 25 billion. We have Goldman Sachs, bailed out with 10 billion. Citi, number 3, 25 billion. Bank of America, next, 15. Wells Fargo. Where's Wells Fargo? Oh, Wells Fargo is number 1. So if you look at the actual top 6 banks that were bailed out, they were all sorry, if you look at the top 6 banks in terms of total derivatives, they were the top 6 banks that were also bailed out in the height of the financial crisis. The only bank that is not on this list is actually Morgan Stanley. They are not. Oh, sorry, there they are. They're 21st. So it seems they're a little bit more realistic. They have more assets than derivatives, so they've kind of got out of the game. But then you compare it to JP Morgan and Goldman Sachs, this is absolutely wild speculation with massive valuation of money. Now, I know this is a bit of a stretch, but if we go to the say this was 200 billion in 2008, well, the total float of GameStop is 56 million. So if the if GameStop went to $3,000 a share, that would be 200 billion. That would probably help a lot more apes out than bailing out these banks. So that just kind of shows the amount of money that's at stake here. It's money that we're not even comprehending. And if the same thing was to happen, the market would crash again. It would be a lot more than 200 billion. So it just shows how high these things can really go. Right, guys, I want to say thanks for watching. Give a like if you enjoyed it. Subscribe if you're not already, and I'll catch you guys next time.